Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I'm your host, Neville Hicks, alongside my two co-hosts this morning, Christoph Barnett and Emil Kalinowski.
Good morning, Neville.
Hello, everybody.
So we don't necessarily have a specific guest on this morning, but it is a time to use this to educate our listeners and have a general discussion on the fascinating world of volatility and where we are in today's stock market, which I guess 30 years ago or close to 30 years ago, we had Black Monday, where the stock market or the U.S. stock market declined 20% in one day, and volatility spiked to 150%. And that, I think we can all relate to losing 20% of our money. But
hopefully not.
Well, hopefully not. Hopefully that's not a scarred memory. But the notion of 150% volatility is a little bit more difficult to digest. So I think we're going to get into the world of what is volatility and why do we use that as a measure of risk, and why are we in unprecedentedly low volatility times. So I guess maybe I'll kick it over to Christoph, and just if you could summarize with us what is volatility? Why do we use that as a measure of risk when it comes to various asset classes?
Well, I guess the big headline from yesterday was that the market declined by 0.5%. Now, that was the first time we had a 0.5% decline since September 5th, meaning we had gone 50 days without a 0.5% decline. Now, that was the longest streak since 1965. So we're actually in quite a low period of volatility. So your question is, what is volatility? Well, we all are familiar with the concept of an average, right? We add up a group of people's height and we divide by the number of people and we get the average height. Well, in statistics, the second idea is how much variation there is around that number. So if the average height is 5'5", then what's the usual variation? Is it 2 inches higher, 2 inches lower? And so that would be a measure of volatility, just how much variance there is around an average number. So historically in the U.S. stock market, we have an average return, annual return of 7 to 8%, and the variation around that return is around 17%. And we are currently in an environment where we're seeing under 10% in terms of this recent year.
Right.
So, yeah, I have a quick question. So under 10%, so that means the average stock return in any particular random year would be 7%. And then currently that means plus or minus 10%. So 17 to minus 3% would be a normal expectation. When you said volatility is only 10%, how do we kind of
So 2/3 of the time we can add the variation to the average. Uh-huh. So if we are 7 to 8% average return, and right now we're at a 10% variation, then we can expect in 2/3 of the time will be 7% the average, plus 10 would be 17%, which is where we are actually for this year, or, as you said, minus 3, which would be 7% minus 10. So we expect that range to be within minus 3 to 17. Now that sounds like a big range, but historically it's been bigger because we said the normal variation is 17%. So you do the math on those numbers.
So I guess the question becomes, you're talking math and various averages and whatnot, and I think we look back through history as to what's happened for guidance in the future. Why are we? Headline is markets are down 0.5%. That doesn't strike me as something that's particularly relevant in the grand scheme of things. I mean, I think we expect the stock market in general to have higher volatility or a bumpier ride because you're in risk assets. Why does that even make a headline?
It seems like our standards have been lowered. Is that what you're saying, Neville? That our standards have been lowered of our expectations, and that we should not be surprised if it's down 0.5%, right? That's normal. Christoph,
Well,
you tell us.
The classic quote is that that stocks will fluctuate, right? And Neville, you hinted on stocks versus other asset classes, and Emil, you mentioned expectation. So expectation is that stocks typically have the highest level of volatility or variation, whereas in the past episodes we've talked about bonds and fixed income, and they would have the lowest level. So if you think of cash in your bank account, we expect nearly zero volatility. So you'll get the percent return, which is the average for the year, and we expect zero variation.
Right. So depending on the asset class, and I guess the correlation in theory should be the riskier or the more volatility, the higher the expected return.
Traditionally, that's the expectation. Now we've just introduced the term risk. So we've been talking about variation and volatility, which has been used to address the idea of risk, which may or may not be appropriate, but in this case, it is the risk that you don't achieve the average return that you're expecting. So if you went to your advisor and they said you're going to make 17%, well, what's the risk? It's a risk that you only made -3. It's not where you were expecting. Whereas in the bank, if you're going to make 1% on your CD, there's essentially zero risk that you won't achieve that.
So I'm a little confused. Is there anything wrong here? Is there a problem? Because we started out talking about that about 30 years ago, the stock market went down 20-ish% in a single day. And now we're at a period where if the stock market goes down by 0.5%, where it's headline news and there are flashing light bulbs and rotating police sirens. So maybe there's nothing wrong. I'm saying
good question.
Should we be worried that it's not too volatile?
It's a very good question, because I actually earlier this year looked back in history to see, okay, what happens when volatility is this low, and all I could find was that volatility increases. It doesn't mean the market went down or went up. It just volatility goes from a period of low numbers to higher numbers, and it didn't really mean anything in terms of the market. So why should we be concerned? Well, I think it has to do with the idea of insurance. So when volatility in stock markets are low, the cost of insurance is cheap. So if you say, I want to insure against my losses, the cost is cheap. Now, if we think in a more real-life example, and storm insurance, hurricanes come by, when insurance is cheap, everyone feels good, they're covered. Well, maybe we're less safe because we have a lower expectation of the next storm, and so we don't prepare for the next storm. It doesn't mean a storm is coming. It just means that perhaps we're underestimating the chance of a storm. And so when we see that 0.5% decline, maybe that's a bit of a wake-up call. It's still not big. But then 0.5% now looks big, right? A small storm looks dramatic, whereas if you had a series of regular storms, everyone would prepare by their insurance.
But it's interesting if you think of, you talk about big storms, and it actually is a really good analogy. But I would think because, if you're in a period of low volatility or the equivalent of no storms, that there's going to be higher volatility in the future, or the chances or the probability of having a storm is more likely, 1 in 100 years or 1 in 50 years, however you want to break it down. If that's the case, wouldn't insurance cost more?
You would think
because
so, right?
It's mean reverting. You expect it to happen.
I think one way of putting that would be that we should not, even though there's low volatility right now, we should not expect that the volatility has disappeared. In a recent paper by someone named Chris Cole, maybe we'll reference that later, he has a really nice quote in there. He was writing about volatility, and he said that you can't destroy risk. You can only move it around through time and assign it to different people. So even though maybe this risk that we see right now seems to be low volatility, but really maybe we've just pushed it off into the future, accumulated it into the future, and we've forgotten that there's this big pile of risk that we've pushed off into the future that may be coming. The storm is due. Is that what we should be worried about during these days of low volatility?
It could be due. right? It just because that's the gambler's fallacy to say, oh, we haven't had a storm this year, so it must be coming next year. Maybe. There's no guarantee. And to Neville's question on the insurance, if I was an insurance seller, I would certainly be nervous that I'm collecting less premiums when the risk of a storm hasn't materially declined. But we have to think of the mechanics of that market. If there are no storms happening, then more insurance providers enter the market, offer insurance, and there's competition which drives that down. And that's a perfect analogy for what's happening in the stock market, because in this period of low interest rates, people are seeking yield on their investment. And so what's happened is people have started to sell insurance on the stock market, and they continue to sell insurance, which drives that yield from insurance down. Now, they'll have to pay out when there is a storm, but right now that's part of what's keeping volatility down.
And that's kind of a great kind of segue. We're going to take a short break, but stay with us as we solve for this unprecedentedly low volatility time.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X.
And now, more Money Sense.
Good morning and welcome back to Money Sense. I'm your host, Neville Hicks, alongside Christoph Barnett and Emil Kalinowski. We pick up the conversation on volatility, and we kind of left with Christoph making a good analogy about insurance and how do we insure risk, I guess, or volatility in the stock market, and why volatility right now is extremely low relative to, I guess, historical averages. I think the question I have too is, I always ask why. You know, why are we in this, or why has this happened, or how do we look back in history and compare it, because we're at a different time. Unfortunately, history is one path to look forward, but looking into the future, there's multiple paths and multiple probabilities, and whether the storm is tomorrow or it's 10 years from now, how do we plan for that, and what are some things that we look at? So maybe I'll toss it out to you guys. You know, why do we think this is low? Is it just a normal time, or is there some other factors out there that are contributing to the current state of the equity markets?
Well, just continuing on my insurance idea, there are many ways to sell this insurance, and it has been a great trade. You've made money selling the insurance because we hadn't had the storm. And so you can, in various derivative products, people are making money selling. You can look up articles. I think there's a Target manager who's making $1 million selling volatility. I
think he quit his job at Target, and he made something to the tune of $12 million on this one trade.
I hope it was not a paper profit. I hope he sold.
Well, I think he's still making money.
Hopefully, he's at some point got to take some of those
I don't want
profits
to
off the table.
throw you off your path.
No. I mean, great point. Like those type of things again are signs of just a low vol period, right? Does it mean that there's going to be some storm? Maybe not, but these are the types of things you would expect to see. Also, you have pension plans trying to enhance their yield, and so they will sell some insurance on their own portfolio, taking in some incremental yield. There are also strategies. This is an interesting one. There are strategies that adjust their exposure based on the risk of the asset. So as, for example, the volatility in equity markets declines, their strategy will buy more equities. Now, when markets are going up, it's a great thing. But again, when the storm hits, volatility goes up. Now they have to sell equities according to their strategy. So
it's a double whammy.
It hits you on both sides. And then another aspect, which is we can get into a bit more, but share buybacks. So a company will borrow money to buy back their own shares, which has the result of there are less shares out there, and then their earnings per share increases because there are less shares outstanding. Now, when are they going to buy those shares? When you have a slight decline in the market. Well, every time there's a slight decline, they buy back some shares, the market rebounds, we have less volatility by definition.
And share buyback is certainly an interesting one. I have a stat here which blew my mind. since 2009, U.S. companies have spent $3.8 trillion on share buybacks, all financed. So historically low debt levels have led to unprecedented amount of share buybacks. And to your point, obviously a stock price is supported by the number of buyers and sellers. And if you have a company who's continually willing and waiting to buy their own stock at any sign of dip, I actually don't even think it's been a dip. I think they're just buying it and driving the price up, which is crazy. So for the listeners, what's the rationale for a business doing that?
Well, there's a small list of what you can do as a company with your money. You can do a new product line, a new business investment. You can pay down your debts. You can make internal, maybe not a specific product launch, but you can make an internal investment for future products. Some research, for example.
Or you could dividend
or you can pay it out to shareholders,
Yeah.
which there's two ways to do it. You just mentioned dividends, and the other way is a share buyback. And that has the implicit function of giving money back to shareholders. It's not a specific payout, but if you think about it, if there are less shareholders, then you own a higher proportionate piece of that company. You've essentially been granted more of the company because there's less shareholders out there. Now, it's interesting because that means that it's more they deem it more profitable to buy back shares than do a new project. What does that say about their prospects as a company?
Or the economy.
Which is a whole separate
They would
question.
invest if there was demand that they
Absolutely.
believed in.
Well, if there are projects that they see a good return from. Now, just to touch on one point, you mentioned the financing. So if they're borrowing funds to do this, we've had historically low interest rates. What happens when, as we've seen in the last year and a half now, interest rates are starting to tick up? What happens then? Can they afford to keep borrowing money to buy back their stock?
Well, I know my mortgage rate has gone up. Right.
Same here.
So, do share backs continue? I mean, 3.8 trillion since 2009. That's insane. Is the only thing stopping that is higher interest rates, or
You would think.
right?
Or a political change.
Well, I think that leads into the next point too. Is, well, if it's higher interest rates, when we talk about, I guess, volatility or broad basing what has caused where we are at from a market standpoint, we think about central banks and monetary stimulus and how much money central banks have printed, and it's close to 15 trillion, 20 trillion.
And that's contributed to low vol too, because you have maybe not so much outright buying on the U.S. side, but the Central Bank of Japan is buying ETFs in the market. They're buying stocks. Same for the Swiss Central Bank. The Federal Reserve, it seems to be more indirect, right? They'll buy a bond from a market participant who then replaces that exposure with maybe some less risky stock and you have to invest somewhere. And so, again, this is leading. So now, but what are we seeing from the central banks? At least on the U.S. side, they're saying we're going to start withdrawing some of that stimulus. So maybe that turns. Now, again, this doesn't mean we have some sort of crash or so on. It just means that perhaps this low vol period goes back to a period of maybe normal volatility. Maybe that normal level is lower. But certainly it seems like it should be higher than the current low period.
And normal volatility goes both ways. So maybe stock prices will go up even further. Isn't that right? Volatility goes both ways.
Volatility, yeah, correct. There's positive volatility, right? It's like during the tech bubble, volatility was actually 15-20%, but markets were increasing. It doesn't mean volatility is indifferent to direction of the market.
So I actually think we were chatting earlier, and Amelia made a good point, or asked. If we think about where the world is at right now, forget the stock market. As I don't know if that's ever the most rational place to look. But if you look at what's going on in the world itself from a geopolitical standpoint, how much impact does, let's say, North Korea have on volatility in the stock market, or what's going on in the Middle East, or the fact that Trump can't get anything tax reform or healthcare passed? How much does that trickle into the market and trickle into volatility when it comes to equity prices?
Christoph, you go ahead if you've got something. But I remember reading several studies that look back historically at stock markets right before the outbreak of war. And I'm picking war just because you mentioned North Korea. But the idea
It's a great way to start the morning off. Yeah.
Coffee and war. The idea and the results of these studies were that markets were wrong-footed, surprisingly. American Civil War was a great example, World War I. The markets didn't see it coming. So even though we read about it in the news, the market may not be reflecting that, which it's not. Doesn't mean it's going to happen. But I would just point out that surprisingly, historically, we've seen instances where the markets were not good predictors of geopolitical shocks.
Right. So what you're saying is World War I, the market was ticking along fine, and then we went to war.
Mm-hmm.
Not the market declined, and they said, okay, let's go to war.
No, I'm saying the market didn't begin a steady decline several months or several years beforehand, looking around at the situation and saying, this is very dangerous. Let's start selling our assets. Let's start moving into cash, gold, whatever happens to be. No, the market was surprised. I can't believe this is happening. That's what happened in several well-known instances. So maybe even now, what's happening in the world seems to me to resemble previous transitions from one era to another era. And during these transitions, these are periods of instability and volatility, but it's not happened yet. So I believe we're in a transition between two eras, but the market's not reflecting it.
Mm-hmm. Okay, so what's an investor to do, right? So if volatility is low, can we buy volatility? It's not easy, and it's expensive because everyone knows. It's like saying, can I buy insurance? Yes. And so while we're in a low period of volatility, everyone's expecting it to go up. So to buy any type of insurance over any period more than 30 days is actually quite expensive because it's currently low, but everyone expects it to go up. So the price of that 1 year insurance, let's say, is higher.
Mm-hmm.
So the most basic thing people can do is if you're 100% long stocks or even you've borrowed money to buy stocks, let's reduce that a bit. And so essentially then you're less exposed to that volatility. We always say have a diversified portfolio, have some bonds and gold, as Emile mentioned, depending on your financial situation. But that's the easiest way without having to pay those high prices for insurance. Just to reduce your U.S. stock exposure, your stock exposure in general can be in the U.S. They have the highest valuations. Again, if we look at history and we say, oh, well, average return is X. If we've had a great bull market, maybe things won't be as high. It doesn't mean we have a crash. It could just mean we have low single-digit returns with some short-term shocks to the system. But that's the easiest way. Well, if we want to get complicated, that's another show.
But I think you made a good point, and we could talk about valuations,
which we have in other episodes.
for another 8 shows. But I'd be interested, you might know this, but does a period of low volatility, is that related to a period where we've had abnormally high stock market valuations?
I don't know.
Okay. Because I would think they would be relatively correlated.
I know that the last time we were in the ranges we are, 9-10% in terms of the volatility index, it was 2007, but that's my recency bias, right? I wasn't following the markets when I was 10 years old.
Shame on you.
In the mid-90s.
Don't lie.
When we had low volatility as well. But in the mid-90s, I mean, we continued, through the end of the century to have good stock returns. So but I would say limited data.
But I think, too, which is you talk about recency bias, and I think that's a huge downfall or investor bias that we all get used to, is that, who here, well, of us sitting here talking, 30 years ago, we had Black Monday where the market lost 20% in one day. I mean, where were you when that happened? I was a toddler, right? I mean, I don't remember how I felt or what I experienced or, and how many people are still around who are still involved in investing, who remember
retired.
that, right? I mean, so it's an interesting dynamic, and I'm not saying tomorrow is going to be Black Monday or we're going to experience that again. But I think if we look back in the past, we need to look beyond what just our recent experiences and think about, things in a historical perspective.
There's more volatility in the markets and in real life than is being reflected right now, and you should introduce some resiliency and robustness into your portfolio.
Right.
Agreed.
So I think that's a good point to wrap it up. There's a lot to digest here, and I think just looking at things through different lenses and looking at different assets when it comes to risk. So thank you, gentlemen, for a great discussion.
Thank you, Neville.
Thanks, everyone, for listening in. And we do encourage anyone who has any questions, please email us at MoneySense, CANW, or you can find us on Twitter, and our handle is at MoneySense Radio. So if you have any questions or want to hear a topic, please do let us know. We hope you enjoyed the show, and we look forward to you joining us again in 2 weeks. Thank you.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.